Bank of America just posted some pretty damning images that, in my opinion, are evidence that we are walking into a poopy-doopy time. I'm going to show you two things that they just said that I think are critical and they're important to know for your investing outlook. Now, keep in mind, I'm going to give you an update as to where I sit on the bull-bear scale. Don't worry, I want to be a bull. I want you to make money, your parents to make money, your uncle to make money. I want everybody to make money because it's easier to run startups in a bullish economy. Everyone's happy that way. People aren't going around leaving nasty comments all the time because everybody's happy when everything's going up. And so I want everybody to be happy. But because I know not everyone is going to be happy if we do go into a recession, I want to point out these warnings because what Bank of America just said is a little scary. Quick note, we're launching an amazing product that can help you if you are scared at all. And it has to do with real estate and finance. We are finally offering a full-fledged financial advice, wealth plan, and custodying platform. So if you want a financial advisor, licensed financial advice from my team, you can now get it. Just go to stockhack.com and you could sign up. We're going to actually begin offering the service on October 1st. And we can custody your assets with JP Morgan. The fees are, in my opinion, excellent and highly competitive. They are just 69 basis points plus a monthly fee of $420. So go check it out, $420, 69, we had to do it. But anyway, we think these are very, very competitive fees for financial advice, personalized wealth plans, and it's not just on stocks or bonds, but my favorite expertise and way to build wealth, real estate. You get it all for a very reasonable price. So go check it out. We begin October 1st, stockhack.com. You could sign up now. The earlier you sign up, the better, because if too many people sign up, we might have to close that webpage down for a bit and start without other signups, essentially. So go check it out over at stockhack.com to learn more. Now, with that said, let's go ahead and jump into a few issues that we're getting leading into a potential recessionary environment. The first is right here. This is a chart of the personal savings rate. And what I did is I drew a line when we were under 5% on the personal savings rate. And what I found is that we were under 5% right before the dot-com bubble for 23 months. So in other words, we broke under it and we stayed under it until we went through a recession. And that's when we finally broke out above it again. And then, of course, when we fell below 5% again, we were under that level until we had a recession again. We were under that level for 23 months from April 99 to March of 01. And we were under that level for 35 months from Jan 05 to December 07. Well, folks, we have been under that level now for 32 months. In other words, according to this alignment here, we would potentially be overdue for a recession within the next 3 months. Now, maybe this time will be different. Maybe people have saved up a lot more money than previously, but this is something to pay attention to, especially since we expect that the unemployment levels not only will continue to prove that they have peaked, but are already indicating that they've peaked. First, you could see non-farm payrolls hiring levels have clearly peaked out. They've been peaked out since 2022, but take a look at this from Bank of America. Bank of America here shows us the following. Government and private and health care sectors on year-over-year growth have peaked. Now, why is that a problem? Because those sectors peaking usually peak last. I marked with a green arrow every time those sectors peaked, and what you'll notice is they always peak out right before a recession. This one was actually right here, a little awkward, kind of right there at the end of a recession. There was also a peak right there before, so you had this sort of like double environment. But what always came before that was a peak in the private sector growth. So when you align those two, you align a red arrow and theoretically a green arrow right there, red arrow, green arrow, red arrow, green arrow. When you align those two peaking, you almost always followed it up with a recession. In fact, the only time I didn't see that happen so clearly was over here in 71, but that's just because the peak over here in government hires was way lower. It was all the way down there. Otherwise, you always fall into a recession after that. Again, maybe this time's different, but what's over here? Peak in regular private payrolls, peak in government payrolls. Not a good chart. That doesn't give me the happy feelings that the markets can continue to skyrocket. Again, I want that to happen, but I am a little bearish right now because I just can't convince myself it's going to happen. That's why I sit at a 3.3 out of 10 on the bear bull scale. We don't even have to talk inversion or all of the other problems or warnings that we're getting. Let's just focus on what we have here. And the second chart from Bank of America right here. Tech, telecom, and healthcare versus financials, energy, and material. Basically, what bubble did you have before the recession? Well, in the dot-com recession, or bubble, you had a tech, telecom, and healthcare bubble. And it peaked at 44% of total global equities. In 2008, you had a peak recession, or right before recession, you had financials, energy stocks, and material stocks peak at, you guessed it, 44% of global equities. And where do we sit today for now going back to 01, but of course this time is different, tech, telecom, and healthcare? Oh, also at a 44% peak. Now, what was the other one when the other was peaking? Well, when tech was peaking, financials were at 24%. When financials were peaking at 44%, tech was at 24%. And today, as we're peaking at 44%, the opposite one, financials, 25. Look at that. You can't make it up. Those are some of the scariest charts I've seen in quite a while, and they're from Bank of America. Now, add to this that people keep caring about the frickin' labor data, and it's keeping treasury yields high, which is pissing me off because the treasury yields should be going down. I'm betting that they're going down, so in fairness, I don't like that. It's still up, but it's still, like, the treasury yields should be going down. I mean, I'm not going to change it with this video. I'm just informing why I'm making those bets, right? People think that, like, oh, you make a bet and then you try to talk it into existence. No, like, I make a bet because I see things happening, and then I explain why I made the bet, right? But anyway, take a look at this. You know, people keep wanting unemployment claims or labor data or whatever. The slope of unemployment does not go up until at least 1/3 of the way through a recession. People need to know it's so lagging. It's the most lagging thing you could take a look at, and people want deflation, yet I think they totally forget that when you're begging for deflation, you remember that it's great for consumers because prices go down, but it's terrible for companies. Customers delay purchases because prices are falling, feedback loop spirals into a deflationary spiral, and then all of a sudden, you have to lay off even more of your staff. Remember, like, I'll give you an example here. Let's say you sell 100 lemonades this year and 110 lemonades next year. You're like, oh, sweet, that's 10% growth. But what if you had to sell them at 85 cents a cup versus 100 or $1 per cup? Well, your old revenue would have been 100. Your current year's revenue at selling more product at a lower price would be $93.50. So in other words, EPS decline, revenue decline. Now you have top line negative growth, bottom line negative growth, and it's a problem. So you try to prop up the bottom line by firing people. Goldman Sachs just announced 3 to 4% of its workforce is getting fired. It's a tough biz. It's tough right now for white collar out there. It's really tough. And so companies are usually quick to adapt, but they're usually too slow to fire. So once you're in recession, I mean, you could adapt quickly by not hiring as much. But once you're in recession, that's when people fire because they have to. They get panicked because they don't want to go bankrupt. Anyway, so with all of that said, I encourage you to go over to stockhack.com, STOCK, hack.com, licensed financial advice service. Now, the cool thing about that is even though you're going to be working with my team directly, whether it's via email or on the phone, however, they're licensed financial advisors. If they have questions about your situation, they can easily pop over by messaging me. I talk to them in the office. We do team meetings on what your situations are. Or sometimes they just pop on the radio and we chat on the radios. So there are great ways that we have to make sure that you are well taken care of and you're getting the Meet Kevin touch through my team. That makes it scalable, but it also makes it fast because if everyone's relying on me, it can take too long. But if you're interested in true, amazing quality financial advice, we're not talking about day trading. We're not talking about swing trading. We're talking about long-term portfolio allocation. We want to hear from you. So go over to stockhack.com. We'll learn a lot more. Thank you so much for watching, and folks, good luck out there.
Advertise these things that you told us here. I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.
Even though I'm a licensed financial advisor, licensed real estate broker, and becoming a stockbroker, this video is not personalized advice for you. It is not tax, legal, or otherwise personalized advice tailored to you. This video provides generalized perspective, information, and commentary. Any third-party content I show shall not be deemed endorsed by me. This video is not and shall never be deemed reasonably sufficient information for the purposes of evaluating a security or investment decision. Any links or promoted products are either paid affiliations or products or services we may benefit from. I also personally operate an actively managed ETF. I may personally hold or otherwise hold long or short positions in various securities, potentially including those mentioned in this video. However, I have no relationship to any issuer other than HouseHack, nor am I presently acting as a market maker. Make sure if you're considering investing in HouseHack to always read the PPM at househack.com.